Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Mathew. Like the name suggests, this show gets you actionable insight on everything mutual fund related. Now, often we look at the performance of equity mutual fund schemes over a period of time, and you look at various metrics. For example, you look at point-to-point returns, you look at compounded annual returns, you look at the rolling returns, you look at the volatility of a particular scheme, but we don't often talk about the down capture ratio. And this is essentially something that captures how much of capital protection that a particular scheme is offering you. Now, the debate is when it comes to beating the benchmark consistently and in fact getting you the most possible returns, there are two ways in which a fund manager can achieve this, and also a combination of those two. One of them is by beating the benchmark by a large margin in the event of a bull run, and the other way is to protect the downside when the market itself is falling. The best fund managers get the best of both worlds. We're going to talk about the second aspect in today's show, and we'll talk about how important this is. Kaustubh Belapurkar, who is Director of Fund Research at Morningstar India, is joining me to talk about this. Kaustubh, this is one of the measures that we've taken from you, the downside capture ratio, and you've shared with me your readings for various categories, among them the small cap, mid cap, large cap and flexi cap categories. Let's first talk about what this ratio is and what it's aimed at.
Sure. Firstly, Alex, thanks for having me on the show. And I think it's a very interesting conversation, right? Because I mean, we're obviously, in a market that's been so supremely bullish for the last so many years, especially on the small and mid caps. And we're talking about, how much of the downside that we've captured. Obviously, we've seen some volatility since the start of the year. But I think it's an interesting conversation purely because what we've seen over long periods of time of fund manager history is that fund managers, and like you rightly said, do a great job in capturing a reasonable amount of the upside of the market, but actually end up protecting capital much more than or falling less than the index when the markets are bearish. And then over a market cycle, a good fund manager can outperform, which is largely actually given by the downside protection that they provide, right? So what does a down capture ratio really denote? And how does the math behind that work, right? So essentially what it's looking at is over different time periods. So you could do it over 1 year, 3 years, 5 years, 10 years. You can calculate essentially which were the months where the index itself gave a negative return, right? So let's just assume we're looking at it over a 10-year period and 120 months, and so let's for simplicity's sake say that there are about 30 months that the index itself is negative, say the mid-cap index in this case, right? In those particular months, how did the fund perform versus the index, right? So suppose in those 30 months, the index on an average fell -1%, right, per month. Suppose the fund's fallen only -0.8%. So it's essentially captured or fallen less than the benchmark. So the down capture ratio would be 80%. So essentially what you want from a fund is an up capture ratio, which is exactly the opposite. How much of the upside of the bull market does it capture? You want that as close to 100% as possible, so that it's capturing the entire bull market. At the same time, as low a down capture ratio as possible, so that it's actually falling much lesser in a falling market, because obviously investors are much more concerned when markets start going southwards, and especially in categories like small and mid cap, so you've seen greater volatility, it becomes even more essential. And I think a lot of fund managers across various time periods have done a pretty good job of kind of managing this downside protection quite well. You would see many funds ranging in that 70-80% sort of down capture ratios, which is I think a sort of good sign.
No, what I've done is I've looked at the 5-year period, and I know you mentioned the 10-year period, but since a lot of schemes have do not have the data for 10 years, I've chosen to take 5 years, and what I've done is I've looked at the best readings on down capture ratio in the various categories, the top 5. And I've also put on screen, or I will be putting on screen, the compounded annual growth rate for these schemes, what the category average was and what the benchmark is. So let's talk about mid-cap first. And what I'm reading on the top is Axsis Midcap, which in a 5-year period has achieved the best downside capture ratio. followed by Motilal Oswal, Mahindra Manulife, and Baroda BNP. So what I'm reading is that the top gainer in this category among these funds is Motilal Oswal. So would it be fair to say that they've got the best of both worlds? And it's not necessarily enough, Kaustubh, to only look at downside capture ratio, right?
Yeah, absolutely. I think you've hit the nail on the head. I think it's one data point to consider. Again, you don't have to necessarily scout for the fund that's got the best down capture ratio, because maybe the up capture ratio is not great, because you want to get the best of both worlds and you want to find a sweet spot within that, right? And that's exactly what, so these are inputs into your decision making that you would look at, and it's not necessarily a case in point. And sometimes what happens also with these numbers is, given the cycle or the style of the fund managers, some of these numbers can also look significantly better than the others. So I will always maybe not just look at it today, but also look at historical numbers, like almost like a rolling down capture ratio over different periods of time, which will give me a better sense about how really consistent a particular strategy has been in limiting the downside and similarly capturing the upside, right? So that will give me a pretty good understanding of how that fund has performed across market cycles. Because if you just think about, yeah.
I want to talk about how these schemes are managed, because I know for a fact that Axsis, for example, which has not just the lowest down capture in a 5-year period in the mid-cap category, but also it ranks in the top 5 in the large cap category, as well as the top in the small cap category as well. I know that they have a more conservative approach, and they have an orientation even within these categories that are broader market towards large cap.
Yeah, that's right. So, there are two things to this, right? The Axis approach. So one is obviously in their mid cap, for instance, they would have some large cap exposure, which would anyways kind of be less volatile. So it'll limit the downside to a certain extent. And I think the other important aspect is when you think about Axis's, style of investing. They're a quality growth manager, right? And let's focus on the quality bit of things. You're looking at companies, with great earning ratios, low debt ratios. Now, typically in any down market, you would expect quality companies to be much more resilient than probably your cyclical sort of high debt company. So I think that also kind of plays, into that sort of lower down capture ratio for some of these strategies. I think also during that crash of 2020, which is during this 5-year period, they did have a reasonable amount of cash. And that's also another important thing to think about, which also resulted in them capturing much lesser of the downside during the COVID correction, and even prior to the run-up of the COVID correction, which would also result in this lower number. So I think it's important to put all of these things into perspective, when we think about the number rather than looking at it in pure isolation.
One last point on the mid-cap category before we move to small cap is Motilal Oswal's mid-cap strategy. They've achieved a 5-year CAGR of 26.39, which handily beats both the benchmark and the category. Is there anything that stands out in their management as opposed to their peers?
To be honest, I haven't really tracked the fund closely, so I wanted to give you a nuanced opinion. But obviously Motilal's built a pretty solid team over the years. While they've had some changes in the past, I think now they've built a pretty solid team. They are a good institutional backed research house anyway. So I think they have all the ingredients in place there. But that's as much as I can comment without really having more information about the way they manage the fund.
Fair point. Let's move to the small cap category, and I'm seeing readings which are pretty low, and I'm talking about 58 for the Axis small cap fund. I'm talking about SBI small cap fund, which is as low as 61 over a 5-year period. That's pretty significant, right? And one would assume that small cap funds find it more difficult to protect downside because of the nature of these schemes. Would it be wrong to say that in certain situations, a low down capture ratio is not necessarily a good thing, particularly if you're in a category to take on a certain amount of risk, and maybe the upside capture ratio would reflect the low amount of risk in that scheme?
I would say yes and no. Yes, you have to look at it in conjunction with other data points like the up capture ratio and other aspects, but it's also important to think about maybe certain funds, because of the inherent style, could be going through either headwinds or they had a tailwind. Like I said, we spoke about the cash or the quality approach, which in fact even SBI Vasan follows for the small cap SBI small cap fund, which should have helped them during periods of downturns. But the quality growth approach is in more recent times is actually struggling, right? And which you would see in the returns of their portfolios over the recent times. So in more recent times, it probably doesn't look that great. But if you roll that data both on the down capture, the up capture, and you look at the other risk metrics for the funds, they actually wouldn't stack up. They would stack up pretty reasonably well. I would think so.
I do want to talk about the Flexi Cap category as well, where a very a familiar fund ranks at the top if we're talking about the 5-year, and that is Parag Parikh Flexi Cap Fund. It has a down capture ratio of 52.87, and in fact the 10-year down capture is as much as 46.43. That's not on the screen, but it has achieved a 5-year CAGR of close to 23%. The category average is 16.67%, and the benchmark has grown 17.9% on a compounded annual basis over that period. And that's quite significant, is it not, Kaustubh? Would you say that because of the kind of investments that they had in the international markets, that's kind of helped them to a large extent?
So again, I think that's a very interesting observation, and I think for start with, I think it's an extremely well managed fund. Rajiv and his team have done an exceptional job in managing this strategy. So yes, there is an element of where the international markets have kind of, because international markets haven't necessarily moved in lockstep with the Indian markets, and especially some of those what we call the Magnificent Seven names too, right? Which they own a couple of those, and that would have helped both. I mean, helped and probably impeded them in certain times because we had this whole crash in 2022, and then 23, these names again took off again, right? But when we looked at the underlying attribution of returns, while obviously the US holdings have contributed quite significantly, it's also been the domestic stock picking that's been pretty brilliant from the Parag Parikh team, which has actually added to the significant alpha this fund has generated over that the entire time period. So I think it's a good mix of both. I wouldn't credit only the US exposure. I think it's a good mix of both domestic and international stock picking.
Yeah, because it's interesting. If I reduce the time frame even further and come down to 1 year, it stands at 18.33, which is absolutely ridiculous. There is also in that list, and I want to pull that list up again, because if I look at the top 5 based on the 5-year down capture ratio, there is Quant Flexi Cap fund as well. And if I look at the Quant's shorter term time frame, and here we're looking at the regular scheme, it has a 99.38 down capture ratio in 3 years and 119.92 in a 1-year period, which means that they have lost more than the benchmark in the last 1 year. What about the strategy would cause something like that? Because they are, as their name suggests, someone that follows a quant-based approach.
So obviously, I mean, given that sort of high turnover and some of their holdings, because of the inherent approach, that could turn to be a little bit momentum oriented. So they'll actually have a pretty high up capture ratio too, but that will also result in a significantly high down capture ratio, like you rightly pointed out, especially over the short time frames. So yeah, it's a very different approach that they take to money management. So that's probably resulting in some of those numbers that you spoke about.
The last category I want to talk about is large cap, and the reason I kept it for the end is because we've often spoken about the futility, if you can call it that, of investing in the actively managed space in large cap, because ultimately the fund manager has such a small pool to play with, the ability to beat the benchmark is compromised. However, over the last 1 year, a lot of them have managed to beat the benchmark for various reasons. I would think to a certain extent the portfolio construction, which is allowed for 20% in the broader markets, has allowed them to outperform. But having said that, how would you read the down capture ratio for large caps? Because I would think that the approach here is not necessarily on the taking on of significant amount of risk and therefore profit maximization. You're also looking at protection of downside when you talk about the large cap category.
Yeah, absolutely. I think you want to be, again, reasonably lower than 100, I would say. That's not necessarily been the case, but I think that's also, not something, I mean, it's more of a market function rather than, because, the problem with the large cap category or the index is that you have such large index heavyweights, right? So the moment some of those top heavyweights significantly outperform, the large cap active managers are lagging. But in years like last year that you pointed out, when you have an HDFC bank which is underperforming, the large cap managers who've been underweight that stock would make a pretty strong comeback. So I think that's one of the challenges, and that's a global phenomenon that you would see. I think even in 2023, a lot of US active large cap managers did, I mean, much higher or better success ratios than some of the others. But I think I still think there's good runway for active managers to play even in the large cap space. I think investors just need to be a little patient across the market cycle because if you're a very growth manager, you will be underperforming more recently. If you're a value manager in 20, you would be underperforming that time, but you're outperforming now. But if you stayed the course, you would have actually made money. But the challenge is for an investor to stay the course, identify that fund and stay the course. But there are, I think, reasonably well-run strategies that can do it. But yes, you're right. I think the runway has shrunk. The number of active large cap managers or the quantum that can beat the benchmarks has come down and will probably continue to kind of gradually drift downwards.
Okay. The last point that I will raise in this, when you rank the various parameters that you would look at, of course you look at the performance over a period of time, but where does this rank when you're looking at determining whether or not to invest in a particular scheme?
I think it's important. It's very important because if I just think behaviorally as an investor, right, we love positive surprises, right? I mean, if I just if anyone told me that okay, you can get an X%, or historically a category or a fund has returned X%. Obviously, that's not the right way of looking at things, but we do tend to pin our expectations on what history has delivered, right? Moment there's a positive surprise, I'm super thrilled. But even the smallest of negative surprises as an investor, any investor, I mean, it's human nature, we would hate it, right? So if a fund can, and if you see the markets that are red and you see your portfolio has fallen lesser than the market, that kind of gives you that comfort. So I think it's an important factor, but obviously it's an interplay of multiple sort of data points that you need to look at, beyond these quant parameters, obviously in terms of the investment team, consistency of style. I think that's very, very important, which often doesn't get spoken about enough. I think that's something that investors should be focusing on, so that they continue to invest in funds and stay invested. I think that's the most important thing.
Kaustubh, when you've studied this over a period of time, has it indicated that a fund that has managed to consistently have a low downside capture ratio has actually done better than schemes that have consistently had an up capture ratio that is beating everybody else, but not necessarily a good downside capture ratio?
Yeah, absolutely. I think two things, right, to this point. One is just the fund returns, right, when you think about it, because typically any fund that has a high up capture ratio in excess of 100% probably also has a down capture ratio, either way close to 100 or higher than 100. We've seen that in the past. They tend to be, slightly high beta portfolios. So it's kind of, in the zone that they would do exceedingly well in certain market conditions and obviously correct most significantly, as obviously the numbers would suggest. And the biggest challenge is not necessarily just the fund return or a point-to-point perspective, but it's more importantly the investor return or an average investor making money in those funds, right? And let me explain to you what that means. Because investors tend to gravitate towards funds that have done well in the recent past, that's human nature. They'll probably end up buying this particular fund because it looks like the top of the pile, but they're buying this fund after that great returns already been delivered, right? And because it's got a large down capture ratio or can be much more volatile, they're probably participating in that second bit of that movement, which is not desirable to them, and they're always chasing the tail for such funds. So I think it becomes a bigger challenge in investor returns or investors getting poorer outcomes from such funds, as opposed to funds that probably are around that 90 to 100% up capture, that we're getting a good portion of the upside. At the same time, we're protecting your downside when the markets fall. It makes for a much more or less volatile investor journey, and investors tend to stay invested in these funds and actually end up gaining most of the returns that the fund would make. I think that's a very crucial aspect when you think about from the art of investor behavior and how they invest their money across cycles.
So it's an interesting point that you make, because I know that we've looked at 5 years, but then you would want to have a longer time frame to study something like this, because you're looking at different market cycles, and we've only really seen the COVID-19 pandemic or the correction that you saw post that over the last 5 years, which was really massive. And there was quite a big recoup of that very quickly. What I want to understand is, how do you study this, and does a different category throw up different results, and do you have different downside capture ratios that you would be acceptable, or that would be acceptable, for example, if you're talking about a small cap category?
Yeah, so I think two things. So, yes, different categories will have different, typically different ranges. And, in the large cap space, actually, surprisingly so, the down capture ratios tend to be closer or higher than some of the mid and small caps, purely because of the fact that, one is you have these 100 stocks, there's lesser active share that the fund managers run. By the virtue of that, obviously, their performances, I mean, there's not a huge delta from the benchmark on either side, right? But with mid and small caps, as we've seen that, you can have really interesting periods where funds are, beating the benchmark hollow, or, the other way, or underperforming quite significantly. So these types of funds tend to have, smaller or better down capture ratios, purely because, even the construct of these indices, you would have stocks. For instance, if you just look at the past 12 months mid-cap returns, you would have stocks that have probably done 400, 500% returns over a period of time. But at the same time, there's stocks that are probably minus 50%. You will not see that range of returns in a large cap index or a fund, right? So I think that then eventually results in typically more palatable or lower down capture ratios. And that's a good thing, right? Because I mean, anyways, this whole category is more volatile. So you want to protect that much more on the smaller mid-cap side as much as possible. And that's what many funds have achieved over the longer time period. And I think the other interesting data point that we, if you just break it down into calendar years. So let me talk about the last big mid-cap rally that happened about 6-7 years back. So 2017, smaller mid-caps rallied. So I just looked at the granular data for mid-cap funds. Not a single fund in that year beat the benchmark, and that resulted in none of these funds outperformed the benchmark. But when the markets corrected in 18 and 19, almost 2/3 or 3/4 of the fund in those 2 years actually beat the benchmark, right, in the mid-cap space. So that's really the testament to what we were talking about. Yeah. That you will capture, or you will protect the downside in falling markets, especially in smaller mid-caps.
And I guess we'll have to look for the next cycle to really see how this pans out, because we've been looking at a pretty stellar up move over the course of the last several months and years, in fact. Thank you so much, Kaustubh, for joining in and for giving us all of that perspective.
My pleasure, Alex. Thank you so much.
That brings us to the end of this particular edition of the Mutual Fund Show. Let us know what you think, and whether or not you saw the readings and measured them according to your portfolio.